Hello, welcome back. Today I'm going to cover an important topic which is on biodiversity risk. So in the past few years, whenever we talk about ESG or sustainability with leadership teams, the discussion has tend to revolve around carbon emissions, carbon accounting, carbon offsets, climate disclosures, net zero commitments, ESG frameworks, and I totally get it why. Because carbon has become the dominant language of sustainability. We all agree. Because maybe the metrics are relatively consistent, because organizations have been under pressure to show the progress. But recently, in projects across different regions and sectors, we have started seeing another risk which is emerging inside the supply chains. And that risk is biodiversity risk, and it's very difficult to measure. It's not like carbon. And for a long time, companies used to think that biodiversity is a CSR topic or it's a voluntary topic. But that risk of biodiversity, which is connected to the nature laws and ecosystem degradation, it started showing up as an operational exposure. Now, because when you step back and look at a supply chain, what you realize is that the chain doesn't just depend on suppliers. It doesn't just depend on the logistic routes either, or contracts. It depends on living systems. Soil health, for example, fresh water, pollination, natural pest control, forest ecosystems that regulate rainfall patterns, coastal ecosystems that protect infrastructure. Now, these all sound like environmental issues until the day production is interrupted in the companies. Costs are shifted, or they're seen upwards, or market access changes. And what's changing now is that it's no longer a CSR conversation. We have seen very clear signals from investors, regulators, and from disclosure frameworks that companies are expected to understand how their value chains interact with nature. The Task Force on Nature-Related Financial Disclosures, that's TNFD, has essentially put a very good structure around this. Now, TNFD is saying that a business should locate where they interface with nature. They should evaluate both dependencies and impacts and assess what is financially material, and then prepare their governance and metrics around that, and then disclose it as well. Now, that may sound very, very technical, but the reason it matters is very simple, because biodiversity risk is not like carbon. It's not global. It's very, very location centric. It's local. Now, with carbon, we measure tons of CO2. We aggregate across sites. We track a trend line. Biodiversity is different. It depends on the habitat health. The diversity of species, of water systems and soil systems, and most importantly, location. It's the same ingredient, same material, same commodity, but if it is sourced from two different regions, they carry completely different risks, because biodiversity always depends on the ecosystem context. Now, one supplier might be operating in a very stable landscape. Let's take the example of a farmer. He has an agricultural landscape, very stable. But another supplier might be sourcing right next to the protected habitat or a deforestation frontier or a basin already under severe water stress. So the company might feel it has supply chain visibility, it has put a lot of efforts in traceability of the supply chain, and they know their suppliers, they know their volumes, but they still do not know their ecological exposure. Now, this is why so many organizations are hitting their wall in their efforts to measure biodiversity. The real difficulty is when companies try to move from a general commitment, like making statements such as we care about nature, and then start following TNFD kind of a management system that can answer practical questions. So they have to answer questions like, where are our highest risk sourcing areas? Which commodities are most exposed? How close are we to sensitive ecosystems? What would it take to prove that a product is not linked to deforestation or conversion of ecosystem? And what would we do if we find that risk? So in the European regulations, like the deforestation regulations, they have made this very, very practical. One such regulation is EUDR. Now, they're essentially saying that for certain commodities, companies must provide geolocation evidence and due diligence to prove that products placed in the market are not linked to deforestation after a specific cutoff date. Now, this forces companies into a new capability they have to develop, that is maybe geospatial intelligence or satellite monitoring, and supply data that includes locations, not just names. And we are already seeing companies respond to this. Let's take example of Nestle. So when they source cocoa, Nestle started using satellite monitoring and farm level traceability to detect deforestation risk in sourcing from regions such as West Africa. Now, because if cocoa supply chains are linked to forest loss, that risk eventually gets embedded in the market access and brand credibility risks. Another example that I can take from Unilever. Unilever, they basically source palm oil, and they've invested heavily in supply traceability and landscape monitoring because palm oil supply chains are closely linked to deforestation risk, and particularly in Southeast Asia where we operate. Now, mapping those risks became very essential not only for the sustainability goals but for maintaining the market trust. And companies like IKEA, they have also taken a similar approach because their supply chain depends on timber. Now, IKEA has started using forester certifications, supply traceability, and landscape monitoring to ensure that wood sourcing is not linked to the forest degradation. So I'm sure that these examples, they show something important, that nature risk cannot be managed from a reporting team alone. It has to come into the procurement department and connect with finance as well. Now, because the decisions that shape biodiversity impact are usually made upstream through sourcing strategies, supplier selection, contract requirements, and how companies respond to these risks. When the risks are detected. What I often see inside organizations is something that I call that they have illusion of readiness. Now, there are sustainability reports, there are supplier codes of conduct, they have conducted their due diligence, there is carbon data, but when you ask which suppliers operate in biodiversity sensitive areas, the companies cannot answer this, because not because they haven't taken any efforts, because tracing the supply chain to that extent and understanding the ecosystem in which the suppliers operate is very, very challenging to reach to that level. And that's where actually the nature sits, close to the supplier. So especially in commodities like cocoa, coffee, palm oil, rubber, timber, soya, beef, all these products. Now, but the good news is that we do have a structure. There are credible building blocks. There are protected area data sets. Key biodiversity area layers are there, water risk maps are there. There are beautiful tools like ENCORE, which translate economic activities into ecosystem dependencies. There are screening tools from WWF, biodiversity risk filter, for example. And for deforestation-linked commodities, now there are many ways to monitor the land use change, but tools by themselves are not enough. Again, the real question is whether companies turn this information into decision rules, whether they are willing to change their sourcing decisions based on the risks that they have identified, and how do they plan to engage with their suppliers differently. Do they need to require traceability upgrades, and should they invest in landscape programs? That's where biodiversity risk engagement stops just being a reporting conversation and it becomes a business conversation. And this is also where the opportunity begins. Companies that build nature visibility early will have stronger supply chain resilience. They will be better and more credible with investors who are now asking nature related questions or ecosystems related questions in the same way as they were asking, or they are still asking, about climate or carbon. So it's very important for companies to be better prepared for the regulatory expectations. Currently these are in Europe, but extending very quickly to global markets as well, because generally global markets follow European Union. So if a company is wondering where to start, let's keep it very, very simple. First, they should start by identifying which commodities and materials in their supply chain are nature dependent or mostly associated with land use change. Then they can prioritize the geolocation. So first, identify the risk, assess the risk, and then take these steps that, to reduce those or to reduce the impact on the supply chain itself. So the focus should not be just on, do we have a biodiversity statement? The focus should shift from there to, do we understand the living systems that keep our supply chain functioning, and what happens when those systems degrade? So over the next decade, that question will sit next to carbon and in every serious sustainability strategy, and the companies that answer it early will not only reduce their risk, but they will genuinely become more resilient supply chains. So let me know if you have any questions around TNFD. We'll be happy to schedule a call. Get in touch. Thank you.